Okay, welcome into my Vanguard portfolio update. Already now for the month of March, almost going into the new financial year here in the UK. Let's have a look quick at what's been going on in the markets before we jump into the portfolio itself, as usual. Now, the big news this month has been the stock market crash / correction, whatever you want to call it. Now, at the moment, at one point, the S&P 500 was actually down 10% from its all-time highs, as you can see on screen now, which technically puts it into a correction territory. Many people were speculating that there could be a stock market crash, but to really get that, we need to be seeing around the 20% drop. Now, anything, of course, can happen in the longer term. If you just zoom out for a moment, though, and just have a look at what's been going on generally around the market, and we can use the S&P 500 as our guide, and we can use global charts too, just to give us a bit of perspective. But year to date is just 3% down, but the 1 year chart is still over 10%, at least at the time of recording this video. Now, knowing my luck, as soon as this video goes out, something wildly happens in the market, whether it's an upswing or a downswing, and all this information goes out of date, which is another reason why I honestly do not pay attention to any short-term price movements, as they're generally going to be irrelevant to what you do as a long-term investor. But it is interesting to see just how quick sentiment changes across the world. All of a sudden, we're going from a booming market where a new all-time highs, and suddenly we're in talking about a stock market crash and recession. Pretty crazy when you think about it. So what's driving this? Well, the honeymoon period for the US president certainly feels like it's over at the moment. The tariffs really are one of the biggest driving effects, certainly when you speak to investors. You can see, will many of them come into effect on the 1st of April, has been speculated, or they're probably going to get changed. I think we may end up in a position where many of the tariffs around the world just stay as they are and end up just, lots of bluster in the background about what can change, but they end up just staying the same and not much ends up happening. The US administration still feels like it doesn't really understand what a tariff is and who actually pays. In the end, it's the consumer, it's the buyer of the goods from that country, has nothing to do with the person exporting those goods. But we will see how this all falls out. I'll be keeping a very close eye on it. Now, another thing I'll be keeping a close eye on, and I did see this article recently from the FT, saying that US shoppers were cutting spending. Now, as an economy which relies on consumers so much, when US shoppers cut back any of their spend, this will have a big effect on the wider economy and the wider market as you go down through the months, and we might see that data popping up. It's quite interesting, really. I think some of this will probably be driven from the fact that when people's stocks go down, their retirement accounts go down, they get that feeling that they actually should hold on to their money more. It's that wealth effect that people speak about. So, for example, if your house is worth a lot and you've got your stocks are soaring to all new time highs, you do generally feel a bit richer. So you might go out and make some purchases which you wouldn't otherwise have done. But when all the market's down and your retirement accounts are, also in the red, you have that feeling that you need to hold on to money. And if you hold on to money, then businesses aren't going to grow and the economy isn't going to grow, etc. So you end up in this spiral which reinforces itself. So if you fear there's going to be a recession and you therefore cut back on spending to hold money, and everyone does that, then you can create basically a recession by just doing that thought in the first place. Now, here's another story which I found quite interesting and does tap into what's been going on in the world at the moment. You may have seen the price of gold just hitting record after record of all new time high. It has actually snuck up on a lot of people, and its price, if you have a look at over the last few years at least, has kept pretty closely to the likes of stocks. It's not an exact match, of course, but it's done pretty well for itself, and certainly at the moment sitting at all-time highs. Now, what this is doing, as you can see in this article, is we've got a bit of an arbitrage, a bit of a trade going on at the moment. So now these large gold bars held in the UK are actually being shipped over to Switzerland, which they're being melted down by this company here, apparently, which is working 24/7. They're struggling to keep up with demand. And they melt them down into the smaller slabs, which I understand that the US market prefers compared to the larger, much heavier ones that we store over in the UK. So you can see here, there's a market going on here for the huge demand for gold, and the UK just selling off lots of those big bars, giving them over to the US, where the demand is just seemingly rampant at the moment. How long this continues, I have no idea, but the company seems to be saying that demand has been steady for quite a long time now and doesn't seem to be going away. Lots of people in my comment section, certainly fearing recession and fearing the end of the world, have been saying that gold is the place to be and where they put a lot of their money at the moment. Remember that gold really is meant to be that hedge. It's meant to be that real hard money, if you like, and not affected by the thing that you can't print ultimately. Money can be printed, you can't print gold. So the idea is that gold should hold its value. However, that's not necessarily always true, and I'm always hesitant to say that gold is just some magic store of value. At the end of the day, it still is an asset driven by supply and demand. And one of the downsides to gold, don't forget, is that gold can't produce any excess returns like a company can produce excess returns. Gold doesn't produce any magic cash flow, can't produce any revenue. It's not hiring people. It's not expanding into new markets. So just be very careful of getting into things like that. I'm not personally a fan of it, especially in the long term. If you look in the true long-term performance of gold, it's nowhere near the likes of stocks or even bonds. So you do need to remember to be careful and put things into perspective, but it's certainly an asset class that's been done well. And if you've held gold as well as your stocks, you've done better, especially the likes of cash, for example. So another interesting story and another interesting asset class to keep an eye on. Now, talking about a new gold rush, EU defense stocks feel like they're the new gold rush, which everyone's running into from away from the likes of AI at the moment. So one of the big companies you may have seen over in Germany, Rheinmetall, now has a forward PE ratio of 100, and it's been up, its stock price at least, 189% in the last year. And it's quite a relatively small company if you think of the grand scheme of things. Revenue, not even 10 billion euros. Now, to put that into perspective, Lockheed Martin over in the US, one of the largest defense contractors, has a revenue of $110 billion. There's definitely a huge amount of growth being baked into these US defense stocks, which are one of the only places in the market where we've seen growth over the past few weeks and over the past few months. Now, this has been driven by defense spending increases from lots of the European nations in response to the war in Ukraine, and suggesting that they want to make sure that they have a lot more defense within Europe without relying on the US. Let's see how far this goes and see actually how much of this money stays within the European Union or ends up actually going to American companies who do make most of the weapons, bullets, etc., and all the things people need in terms of defense. Okay, just quickly jumping closer to home. And there was a couple of stories I do wanted to cover from the UK perspective, and they may get their own video and we'll see how things go, especially when we talk about the spring statement, which is happening on the 26th of March from Rachel Reeves. Now, one of the things which has been speculated by a lot and lots of people have made videos on is the limit around cash ISAs being put at potentially just £4,000 for the year. So similar in that the lifetime ISA, you can only put £4,000 in. The cash ISA may be restricted to putting just £4,000 in, with the ISA allowance still remaining at £20,000. Now, the idea behind this is that you encourage effectively more people to take that money and invest it instead through something like a stocks and shares ISA or a lifetime ISA, something that I speak passionately about on this channel and have been doing for a number of years. However, I don't really think this is going to have the effect that people think it does. You have to reflect on why people have money in a cash ISA on the first place and why many people leave money in a cash ISA for, longer periods of time when actually they're really designed for shorter periods of time, or any cash savings product is designed for the short term. And this has to come down to the fact that the vast majority of people just have no idea how to invest their money, and also no idea really on how the time value of money and how inflation eats away at their money. So I don't think personally that if this limit did come in, it would help really anyone, and would, hardly force anyone to move their money from a cash ISA to a stocks and shares ISA, because that gap of knowledge is enormous. And all you're going to do really is make people pay a little bit of taxes potentially on their interest from cash. They're just going to move it to a normal cash bank account where they're going to get even poorer results. I think this would be a very poor decision if it were implemented, but there are a couple of big ways around it, and I'll make long dedicated videos on that one. For example, really, you can put this money into a stocks and shares ISA, for example, and you could buy something like a money market fund, or you can even just leave it as cash inside stocks and shares ISA accounts from certain providers and get high levels of cash interest anyway, because they'll use money market funds for you in the background. So I'll do dedicated videos on this one, but it will be interesting to see. I can't be asked speculating much more on that. I'll be very interested on the spring statement on the 26th to see what happens, and I'll be keeping a close eye on that one. One more news story I wanted to cover on the UK was the UK GDP shrinking. GDP fell 0.1% in January. The OECD has reduced its target for growth. Now, one thing I did want to just point out on any of these GDP, all this GDP data that does get reported, it also can get revised. So if you look through previous data, you'll see that the bars that at least are presented from the news sites, from the ONS, can wildly vary. So for example, GDP can get revised from 0.4% up to 0, or it can get revised from 0.2% down to basically nothing. And this is a huge difference in what potential future growth might be. But GDP does get revised because it's actually very, very difficult to try and quantify this and record all the different data and all the different sources. So the ONS does say this on its site about how they record this data, and everyone reports on it instantly when that first data gets released. But this fall of 0.1% could get corrected or changed either negatively or positively. So when it's this close, I don't personally put too much weight to it. Lots of the doom channels are always going to comment on it and say, oh, the UK's finished, etc. And there's so much money for the doom channels just to get all those clicks. That's not really something that I want to focus on. I did just want to say that it can get revised. So you can make a doom story around 0.1%, but it can be revised to plus 0.5%, for example. The swing could be something like that or that much. It's happened before and it may happen again. Now, one quick final story from the UK. I know I said that was the last one just before then, but apparently HMRC is probing into potential taxes on capital gains that people have been making and not reporting. Now, as you know, or many of you may or may not know, capital gains allowances for us all used to be £12,300. It then got cut to £6,000. And in this current financial year, and at least financial years moving forward so far, it's just £3,000 per year that you're allowed to make a capital gain before you then have to pay different levels of taxation. So there are lots of people being caught out on this or just not reporting what they should, and HMRC is probing into this. Now, as many of you will know, at least when you're selling stocks and shares, there are no capital gains taxes to pay if you are using something like your pension or your stocks and shares ISA. So the big lesson here, as I always keep telling everyone, is make sure you get any investments you can into ISAs and pensions. Obviously, I can't give you financial advice. I'm not a financial advisor. But if you can use these tools, you can avoid having to pay taxes like that in the long run. Obviously, there's nothing you can do if it's a buy-to-let property, etc., or something fancy like that. But what we're talking about here is anyone selling stocks. Really, I don't want to see people get caught out if they don't need to. If they haven't already maxed out ISAs and pensions and are using general investing accounts, and there are millions of general investing accounts out there, and I would wager that the vast majority of those people still aren't using their ISA allowances. So anyway, just a good reminder to do that. Right, let's have a look what's been going on in the portfolio over the past month. And actually, I was going to normally do this on the Vanguard website, but apparently it won't let me log in. So I'm having to use the app for the first time, which is a relatively new invention for Vanguard. Not something I actually keep an eye on too much. But here we go. I'll be recording my screen. Now on my Vanguard account, as many regular viewers will know, I hold one account with Vanguard, and then randomly there's some old money left in the stocks and shares ISA. So I always forget about that. Really here is my self-invested personal pension. And I use Vanguard specifically for this because the money I contribute into this pension all comes from my limited company. So money is allowed to come from that limited company as an allowable expense and goes directly into this account. And as an allowable expense, there's no corporation tax that was due on that money. And it also means that if I wanted to take that money out of the business, I don't also have to consider anything like dividends taxes. So this is an extremely tax efficient way to pay into a self-invested personal pension. And I do this because ultimately I'm my own employer as a director of a limited company. So no one else is paying my pension for me. So I want to make sure I try and get as much in as possible in the most tax efficient way. So let's have a look here. I actually don't know if the app has all the data that I like to normally go through on the website. So we'll have a look through here and just see what's been going on. Now, as you can see, the past month has been a very bumpy ride. And at one point, the portfolio was nearly touching £69,000 and went down to a low of around £64,000, as you can see here. And since then, which reflects the wider global markets, we've had a little bit of a pullback, but we're nowhere near those all-time highs that we last saw. It's unfortunate we haven't got that monthly view that they've got on the website, which I actually quite like to look at. But instead, let's have a look at the transactions. So as many of you know, I just invest into this one every single month. The money I invest isn't exactly the same. I basically try and invest what I can. And if business is better, for example, and depending on the end of different tax years, for example, I will put more money in. At the moment, my last two buy orders have been for £3,000 in February and £3,000 actually as we go into March. And I may actually try and put a bit more money in before the end of the tax year. We'll see if I work things out in the business, or I might just wait until the new tax year. But either way, if I put it in on the 1st of April, it'll still count as this tax year anyway. And part of me is really enjoying the fact that the market is low because I always just see that as a discount. One point I wanted to make in this video and that I made in my stock market crash video that just went up recently was that whenever I look at my account, and I would kind of say this to lots of other people too, I don't look at the number of the green number here, for example, and say, wow, I'm up 25%. That number really is irrelevant. I think for most people, we'd be better off if that was just completely removed from any app or platform. Unless you are selling an investment and make that gain, you have not made or lost anything. You know, that could be minus 50%. Doesn't mean I've lost 50% of my money. Until I make that sale, it's totally irrelevant. So I think as a long-term investor, it's really good to get that out of your head. And personally, I just don't worry about that at all. Now, over the long term, yes, of course, I do hope that the money will grow in assets, in stocks, effectively. We're buying shares in companies, which we hope will do well in the long term. But from a short-term perspective, I just don't care about any of this. And from a selfish perspective, if you're a long-term investor, I mean, I would rather be able to buy in really low prices now, and then later on, the ideal scenario would be in a couple of decades' time to have a much larger pot. I'm not in control of that. And a point I've made multiple times in portfolio updates is that I invest no matter what the price is. And lots of people still can't really get their head around that because they say, oh, you should just wait and hold money for these dips, as if we've got some kind of magic radar that allows us to know when a dip is, when the bottom is, and we're all magic market timers. If that were the case, there would be many trillionaires out there who have magic skills, but nobody has these skills. And you're far better off just to do this on a regular basis and automate it. The moment you try and time the market, you're playing an absolute fool's game, but people will continue to keep playing the fool's game really forever, I think. So I'll let them play the fool's game and I'll just stick to things slow and steady. Now, on the investment itself, I'd like to keep things super simple in this self-invested personal pension. And I invest in this fund here. You can see it's the FTSE Global All Cap Index Fund accumulation version. Effectively, I am a global stock market index fund investor, 100% stocks in there, and it's just going to be based on the market cap weight. So all of the biggest companies, Apple, Microsoft, Nvidia, Tesla, Google, Meta, Amazon, you name it, are all going to be in this index fund. And over the months and years as they go up and down, I'll own a very small slice of those different stocks. I like to keep things super easy because I have no idea where the next growth is going to come from. I don't know if the US might be seeing a bit of a poorer time for the moment, for example, and everyone moving their money to Europe, to European defense stocks, for example. I've got no idea how long that trend's going to continue, but I do want to know that I want to benefit regardless of where investors want to move their money. So as a global index fund investor, I personally think this is one of the only ways to do it properly, because you have to go from that position that says, I have no idea where the growth's going to come from. So the best way is to own everything. And that old story that John Bogle would say is that, stock market investing and index fund investing is owning the entire haystack and not just trying to find the needle in the haystack, which lots of active managers like to try and do, but actually the vast majority of them fail at over a long period of time. So there we are for another month. As usual, I put my money where my mouth is. I invest every single month, no matter what, even when the world is seemingly crumbling around us. And that's actually, I think we'll look back on times like these, months like these in the years to come and just think it was all a crazy, stupid panic that many people either worried way too much on or just put themselves becoming super bearish for no reason really. And even if I felt bearish or felt like there was a recession coming, I still wouldn't change the way that I invest, which many people still can't get their heads around. But anyway, that's what I do. I hope you've enjoyed the video. I will see you in the next one, and I'll leave a couple of others up here for you now. As usual, happy investing.